Hello and welcome back to Tradecraft Simplified. Today we'll be talking about the moving averages for investors and swing traders. So this is not for day traders. To start with, we're going to talk about the concept called the DCA, dollar cost averaging. So for non-traders who buy stocks in the financial market or gold or any commodity, most of them usually just set aside some money every month to buy a number of stocks or ETFs. Maybe every month they buy $100 worth of S&P 500, something like that. So this is a form of dollar cost averaging. Usually this is perfectly okay, and in the long run you will still make some gains. However, the more experienced traders wait for some key levels to buy so that they can maximize their gains even more. Swinging, the laws of trading are simple. Buy when it's low, sell when it's high. This is the best way to maximize your profit. But how do you know when it's high or low enough for you to buy or sell? So for stocks, many people rely on news, on earnings, events, and so on to predict when the stock will go up or down. For price action traders, meaning those people who check charts, all they do is check the charts, and from the chart they can predict when the market is going up or down, so they can sell or buy at a very good rate or at a very good level, which is usually at the end of the swing. This can either be seen as a way to invest or a way to swing trade with margins and leverages. So what is the strategy? We are plotting two moving averages. The first moving average is the chart time frame, anyone you want. It could be 5 minutes time frame, 30 minutes time frame. And the second moving average is going to be a different time frame higher than the first one. So if the first one is a 5 minute time frame, then the second one will be the moving average in, let's say, the 30 minutes time frame or the 1 hour time frame. So quite higher time frame. Ideally, you set a stop loss at the cross, the SMA cross, if you're a swing trader. However, the distance or the pips is often too large, so you can wait for a pullback into the moving average line or use any other form of entry rule to minimize the amount of pips you will lose or risk. So you can exit the trade when you want, or at most when the SMA crosses again. It's quite very simple. So let's go test. So this is a 5 minute chart. We have the two SMAs. The first SMA, this white line, would be the 5 minute moving average, and the blue line is going to be what I set, which I put a factor here, a factor of 6, which means 6 times 5. So this is the 30 minute moving average. And like I said, when we cross over, for example, when this crosses below the blue here, we assume we are in a downward movement, so we can sell, and we can see the market went actually further down. This is another one. We broke above, right? And even though the market retraced a little bit back to the moving average, it just went up from there, and we had a very long till September, like a full month or more, and immediately we crossed below again. We have the market going down a lot, and when the market also broke above this blue line, we have a long bullish market, which the market went down to the moving average, but sprang up, and it's been up since then. So since November till today, December 27th, this trade has been running. This is the strategy. It's very simple, and it's for swing traders or investors. So your stock was moving up, and when you reached here, you know that your stock is likely going to start going down. You sell immediately. Then wait for the market to go down and for it to start coming up, which is going to be here, and you buy here and you wait. The market keeps going up, and when it crosses below, you sell because you know that the market is likely to start going down a lot. You sell over here, then you wait again, and you can see the market's here again, then we start going up. So this for Tesla. We can also use it for another market. Let's say for the ETFs, like S&P 500. That's SPX. We should get something similar, right? So market is going down over here, right? We can decide to sell our market, sell our ETF over here, because we think that the market will start going down, which it actually did go down, but went back up a little bit. But let's see where we are coming from. So you could have bought here, right? And if you held it from November 21st, it went up until here, and that is a lot of pips, right? So the same thing here, right? You buy here, and the market went a bit up, but still came down anyway. So this is why you usually have stop losses if you are a trader. Right? You can see the sell signal here also goes down a lot. Same if you keep going back. Same here, you buy here, right? And wait for the market to go up. It actually went up a lot. And you could have sold any way you wanted. You can use the signal, combine it with what you like, trend lines, and to get your perfect entry. Instead of entering here, I could say, okay, I want a counter trend line, which I draw here. Then, I enter at this point, or somewhere here. From here, I draw a counter trend line, and I enter down here. Or from here, I draw a counter trend line and enter around here. Even if you took a trade, you would have lost or something, but it's not the end of the world. Losing is part of it. The same thing over here. We have a very good trend, or we could just draw a trend from here, right? And wait for market to touch trend again. Then you enter from here, and the market goes up. So wherever you want, right, you can be creative as much as you want. Just wait for the signal, then do some other analysis to ensure that you are entering at the right point. By the way, we could just change the settings here for the bar look back. Yeah, this is quite important in some cases where you want to be sure that after crossover or a cross down, that the price crosses the previous low or the previous high. So you can reduce the amount of bars you look back. And there's also the SMA length. If you want a shorter one, you can make it 100. Yeah, the SMAs are a bit shorter, but yeah, just play around with it and see which one works better. Lastly, the slow SMA TF multiplier. This is the time frame. So whatever time frame you have, the slow SMA, we're going to multiply by this. So 5 minutes with 5 minutes and 5. If it's 6, 5 minutes and 5 with 30 minutes. If you want 1 hour, it's 5 minutes times 12. Will give you 1 hour. We can see how that affects this significantly, right? So if I put 6 here, the 5 minute moving average broke below the 30 minutes moving average. But if you have a higher time frame, right, like 1 hour here, we won't have such cross. Try all this out and see how it works. So let's move to the coding section. All right, welcome back to the coding section. And this is going to be a bit very quick because we have very little to write. So as usual, we're going to be starting with the inputs. And so this is the first input, the SMA length. We're using 200. And for the slow SMA, we want to use whatever time frame we have times whatever we input here, right? So this is going to be the slow SMA, the blue line here. The white line here is the current time frame SMA, which is the 200, right? So the bar look, we want to look 200 bars into the past. to draw a line and place a limit order on the highest or the lowest of those candles in the past. So we also have these multipliers for the risk and reward if we want to play around with that. Now we want to create our variables, which are, the first is find the time frame for the slow SMA. It's the current time frame here multiplied by the multiplier we put here 4. And for the slow SMA, we have to wrap our SMA in this request security, because that's how we access something that's not on the chart. So on the chart, we have S&P 500, we have 5-minute time frame. But if we want to access something else, like let's say different asset, a different time frame, we have to actually wrap our value right in this security request. So if you're seen it for the first time, that's actually how it works. Then we're going to look for the highest bar in the past and lowest bar in the past. This is going to help us to draw a limit order. If you've followed my work for at least a while, you will know I like half a state. So let's initialize this, and we want to know when we have a crossover. It could be a crossover up, cross under, right? So this is what we have here. It is a bullish SMA crossover. We want to make the bullish true, the bearish false, because we have ended the bearish trend, and the bear limit order will be NA. And for the bull limit order, we want to set it with the marks of either the current high or the highest bar in the past 200. So next is to get our buy signals ready. So by default, they are false, and we're just going to have a condition to make it true. So we are saying that if we are in the bearish trend, which is confirmed when there's a bearish crossover, and we have our bear limit order set, then we want that one bar has already crossed below this limit order, at least one bar. Then the next, we want to set our state to be as traded, right? We only want to have one signal at a time. We're only going to receive it once per crossover. We just have to plot our shapes, both the triangles and the lines, the SMA lines.